Let's talk about car insurance, brought to us this week by Garrett Clevenger. First thing to know is insurance companies hire statisticians to calculate the math used to drive their policy prices. They use a branch of mathematics called actuarial science. This video will explain two main concepts behind insurance. The first concept to explain is the law of large numbers. An example of this is flipping a coin and seeing how many times you can flip heads in a row. It's possible to flip one or two heads in a row easily, but the more times you flip the coin, the harder it will be to keep getting heads. The theoretical probability of flipping a head is 1/2, or 50%. But the probability of flipping two heads in a row is 1/2 times 1/2 equaling 1/4, or 25%. The probabilities quickly get lower the more times you flip a coin. The probability of flipping 4 heads in a row, for example, is 1/16, or 6.25%. Now, let's pretend you don't know the theoretical probability of flipping a head is 50%, so you decide to do an experiment and record the data. The more times you flip a coin, the experimental probability of you flipping a head will get closer and closer to the theoretical probability. So much so that you can accept the result is the actual probability. The second concept to explain is weighted probability, which is a little more complicated but more relevant to car insurance. Let's say you take your knowledge of probability and decide to go gambling. You contemplate playing a game where if you roll a fair dice and roll a 6, you win $6. If you roll anything else, you lose $2. Should you play? No. Why? If you play long enough, you will lose money. There is a formula for finding the average amount of money gained or lost in these types of situations. You multiply each probability by the money gained or lost and add the percent. So here's what we know for this game. The probability of rolling a 6 is 1/6. The probability of not rolling a 6 is 5/6. You get $6 for rolling a 6. You lose $2 for rolling anything else. So the average amount of money gained or lost in this game is calculated by 6 times 1/6 plus -2 times 5/6. This amount is equal to -0.66, or losing 66 cents per game. Therefore, if you played 1,000 times, you would lose $660, because it's 1,000 times 0.66. Let's hope you quit way before that happens. At this point, you might be wondering what these two examples have to do with car insurance, or really any insurance. We know insurance companies insure a lot of people. Think about flipping the coin a lot of times, and that each person pays a small amount of money each month and nothing happens, hopefully. But just like in example 2, every now and then the insurance company has to pay a lot of money to a single person. Here's an example. You're a small insurance company that insures 1,000 people. Let's say that there are 5 car accidents per year. That means the probability of there being a car accident is 5 out of 1,000. Therefore, the probability of there not being a car accident is 995 out of 1,000. If someone you insure gets into a car accident, you have to pay $30,000. Every person you insure pays $20 per month as their premium, or $240 per year. So using our formula from the weighted probability example, we have -30,000 times 5 out of 1,000 plus 240 times 995 out of 1,000, which equals -150 plus 238.8, which equals 88.8. So on average, you as the insurer would be making $88.80 per person. That's $88,800 per year. Now remember, this is an average, so it could be more, it could be less, which is why insurance companies want to make sure they have enough money to pay out all legitimate claims. Obviously, in real life, insurance companies have policies for things other than cars like fires, homes, personal belongings, and that based on age and driving record, the probabilities specific to you get added into the formula. Hence why these companies hire actuaries, the statisticians who calculate these things, to figure out how much to charge you. In another video, I will break down the specifics of what factors affect your car insurance rates, like liability coverage, uninsured motorists, things like that. For now, enjoy knowing a little bit more about how insurance companies work and the math behind their general policy prices. See you next week.